Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello, and as always, we're going to run through the most important charts and themes that we're seeing today in markets and investing. Huge show today. There's so much going on. We're going to talk about the latest inflation report. We're going to talk about the ARM IPO. We're going to talk about the UAW strike and so much more. So stick around to the end. And if you like the content, as always, hit that subscribe button. And let's dig into that inflation report. And the real concern is a second wave of higher inflation coming. So let's rewind, talk about where we're coming from in terms of inflation. We had 12 consecutive monthly declines in that inflation rate from June 2022, when it peaked at 9.1%, to June of this year, when we hit a low of 3%. And that was fantastic news. The markets really responded well to that this year in terms of the first 6 months and seeing that rapid rate of decline. But now the last 2 months, and this was expected, we anticipated inflation going up because of what was going on in the commodity space, and we'll talk about that. But last 2 months, we've seen inflation move higher, 3.2% in July, and now 3.7% in August, second straight increase. So the concern is that this is going to start trending up again. We're going to see it push above 4% at some point in the next few months. So in terms of that overall inflation rate, trend had been lower for 12 consecutive months, now moving higher. But the good news in the report, if you're looking for a positive, is that core rate of inflation continued to move lower, down to 4.4%. So if you're the Fed and you're looking at this, you're probably saying, well, not enough to do anything when they meet next week. So the expectation is that the Fed's going to pause, and that core rate of inflation moving lower has to be comforting for the Fed. And the big driver of that, of course, is that housing inflation has been moving lower and continues to move lower. So what's pushing up US CPI? Well, it's really the energy space, and particularly gasoline and fuel oil. So big increases if we look at August in terms of gasoline and fuel oil, in terms of price increases, and we're seeing the highest levels of the year in September. So for 6 months, for March, April, May, June, July, and even in August, we had these negative year-over-year prices really helping CPI, and that is likely to change in September. So even the rate of change decelerated here, it was still negative, but so far in September, we're seeing this flip over to being positive on a year-over-year basis. So we're seeing two different forces. One is going to start pushing CPI higher, and that would be the energy space, and the other, shelter, being a positive force pushing CPI lower, because we're seeing that with a lag, shelter CPI is starting to reflect the declines that we saw in home prices and rents. And so if we look at the comparison to last June, really no comparison. Things are much better today than June of 2022, when that inflation rate peaked at 9.1%. Almost everything is lower today than back then. And you're seeing just outright declines in gas utilities, fuel oil, used cars, gasoline, and medical care, and a number of other components up way less than they were last June. And big one here being food at home. And I'll talk about that in a little bit as the most positive factor, the fact that food at home now is below the low overall rate of inflation. So at 3% in the past year versus 3.7% for the overall. Great news there. What are the two components that are higher today than they were last June, in June 2022? We have transportation, so stubbornly high here, 10% increase over the last year. We have big increases in car insurance that we've talked about. And of course, airline fares. If you've traveled recently, you know that they're still elevated as well. And you have shelter, that lagging component that's moving higher. And if it was reflecting real-time data, it certainly wouldn't be at 7%. It would be flat to down, let's say, on a year-over-year basis. So overall, much better than June 2022. But what's pushing it higher as compared to just a few months ago? Well, it's the fact, again, that these declines in, let's say, fuel oil and gasoline, much lower today. So we were looking at a 36% year-over-year decline in fuel oil, 26% in gasoline in June. That helped push CPI down to 3%. and still declining on a year-over-year basis in August, but much smaller declines there. And if we look at that shelter component, this is by far the most important component here. 7.3% finally moving in the right direction. Now we have 5 consecutive moves for shelter CPI downward here. So peaked at 8.2%. That's the highest since the early 1980s. And with a lag, it's finally starting to reflect actual rent prices, actual home prices, which have really stagnated over the last year. Welcomely stagnated in terms of rents here, actually down 1.2% if we look at real-time rent. So why is CPI still at shelter CPI still at 7.3%? Well, it reflects this data with a big lag. It's using surveys, it's using a 6-month average in terms of looking at rental prices, a number of factors leading to that huge lag. But the expectation is it's starting to play catch up, and you should see a continued move lower on that year-over-year figure. Now, the monthly number for shelter CPI could still continue to go up, and the reason for that is there's still a gap between where housing inflation has gone since the start of 2020 and where shelter CPI is. So there's still shelter CPI showing a 19% increase since the start of 2020, but actual rents up 23%. If we look at home prices, not on this chart, but it would show a 45% increase since the start of 2020. So clearly, shelter CPI could still go up in terms of the monthly numbers going forward. It's just that year-over-year number is likely to come down, and I think come down dramatically by the end of the year, assuming that we don't see a big shift in terms of rents. So what we have in terms of the best figure for consumers, for everybody, is food price inflation moving rapidly lower, now at 3%, below the overall rate of inflation. And why this is so important, such good news, is this is one of the few things it's really hard to cut back on. If you could try to find a cheaper grocery store, but very difficult to cut your consumption of food. And so this is not something like a discretionary purchase like travel that you could cut, or even eating away from home in terms of restaurants. I guess you could cut that, but grocery spending is a staple. And the fact that it was above double digits, was above 10% last year, was just unbelievably difficult for lower income households. So the fact that we're down to 3% now, very good news. Hopefully that holds. Hopefully that continues. So the positive thing is that the rising commodity prices in crude oil and gasoline are not being accompanied with rising prices so far in the agricultural space. So things like wheat, corn, soybeans, still down over year-over-year basis, still looking good. So hopefully that remains to be the case. And if you've been to the grocery store recently, this was a huge issue in January. Everybody was talking about the price of eggs skyrocketed higher. People were going out and buying chickens. Well, this picture has changed dramatically since then. $4.82 a dozen for a dozen eggs in the U.S. in January. Now we're at $2.04. So back to normal in a very rapid fashion here. And again, hopefully this continues in terms of food price inflation. It wouldn't be bad if we actually saw food prices come down on a year-over-year basis. Of course, that would be welcome, but certainly you don't want to see this start to trend up again. So the question for the markets is, what does the inflation report mean for the Fed? And what the market's saying is pretty much for sure the Fed is going to pause when it meets next week. So nothing in the report changed anything from the Fed's perspective. That's the market's interpretation. The fact that I think core CPI continued to come down, and we have CPI at 3.7%, kind of Fed would tolerate that. I think for now, as long as the Fed funds rate's above that CPI, and as long as we're seeing wage growth outpace inflation, the Fed is comfortable pausing. So 97% probability that the Fed is going to do nothing when it meets next week. That's pretty high. That's pretty much a done deal, because the Fed has done what the markets expected to do in every single meeting since 2009. So a day before the meeting, I'll do my usual tweet, tomorrow's news today, and I'll say that the Fed is going to pause at 5.25 to 5.5%, and they're going to continue to shrink their balance sheet. So balance sheet reduction continues. So no change in terms of the Fed for September, but what there has been a change is in the expectations looking out further than that. Now the market's saying the Fed's going to pause in November, and so that had shifted. The market was thinking about maybe a hike in November. Now they're saying a pause in December. So this would be the last. No more hikes for this year, and pause into next year until we get to June 2024, when the market's now saying Fed's going to start their rate cutting cycle. But very interesting here. That's been pushed back, and the cuts over the next 2 years are only expected to go to 4%. So the market's saying the Fed's going to be wanting this Fed funds rate to be higher for longer. And I think the market perhaps is saying that inflation may be a little bit more stubborn than people were expecting. And the idea that we're just going to get back to 2% and stay there, maybe it's going to be a little bit more challenging. And that will lead the Fed to keep rates a little bit higher than people expected. But for now, market saying the Fed's done. What could change that market's expectation? Well, it could be a surge in commodity prices. And if we look at crude oil, not moving in a direction that you want to see, a pretty rapid advance over the past 2 months, up around $25 a barrel over the last few months. And we're at $90 a barrel now. Still less, obviously, than last year after Russia invaded Ukraine. This spiked way higher, but highest levels of the year, up 12% on the year now. And that year over year rate of change in terms of crude oil is now positive. And what is this going to do to gas prices? Well, likely it's going to push them higher. We're at $3.85 a gallon here. Wouldn't be surprised if this really started to move higher in the coming weeks. And what you'll notice here on this chart, which is going to be important for that September CPI reading, is the fact that we're now above 2022 levels. So you can see for a number of months here, particularly in June, you see that huge gap. We were way below 2022 levels, and that was helping push down CPI. So you had these huge negative numbers from gasoline and heating oil and things like that. That was helping push CPI down. But now for the months of September, we could very well see a positive year-over-year number for gasoline, depending on what happens in the next few weeks. But that, at the very least, is not going to be a tailwind driving CPI lower, and it could be a factor driving it higher. And if we look at that commodity space, you could see it here. These are looking at commodity futures change in price over the last year. Well, no longer are we seeing gasoline prices and crude oil prices in that negative territory. Now we're in the positive territory and above CPI. So if this holds for the rest of the month, what we're going to see is a positive contribution to higher CPI. Thankfully, we're not seeing it yet in the ag space in terms of wheat and corn, still down around 30% over the past year. Hopefully that continues. And thankfully, natural gas remaining tame as well. So if you're looking at your gas utility bills, hopefully that remains low as well. But the big fear is that we're going to see higher crude oil and higher gasoline, and that's going to contribute to higher inflation. Now, why is this somewhat surprising in terms of the rise in crude oil here over the past few months? Well, it's because we've been hearing that there's been a slowdown in global growth. And what you tend to see when you have this slowdown in global growth is less demand for commodities, particularly for crude oil. And that's what we saw in the back half of 2022. And now we're starting to see the opposite here. So perhaps the market is saying, in terms of crude oil, there's going to be more demand. We're going to see these numbers go up. But it's interesting to see crude oil rise when we have a number of the European economies teetering on the edge of recession. So a country like Germany, 2 consecutive quarters of negative GDP growth. It depends on how you define a recession, but some would say that's already in a recession. We have Finland, Poland, Ireland, Sweden, all negative on a year-over-year basis. And if we look at UK and Italy, just barely growing. So US still sitting pretty good here, 2.6% year over year in terms of real GDP. But the question is slower global growth in China and in Europe going to put pressure on the U.S. economy? But for now, that doesn't seem to be the expectation. We'll talk about the expectations for Q through 3 GDP in a later segment, but the expectations are pretty high that economic growth in the U.S. is going to continue to be strong. But that's the big factor in terms of crude oil. It's the direction of the global economy and the demand side. ultimately is going to drive things. So in terms of markets pretty happy with that CPI report. I'm pretty happy, of course, that the Fed is expected to pause. What we're seeing here is that VIX just plummet again. We're down to 1282 on the VIX, the volatility index. This is the lowest since January 2020, and so pretty calm. That fear that we talked about a few times this year really no longer there, and a big driver of that, I think, is the returns here of the enormous eight. So big tech still having a monstrous year. These are the story stocks. These are the stocks everyone talks about, they tell their friends about, and huge gains, tripling in Nvidia, Facebook or Meta, that it's now called, up 159%. Tesla more than doubling on the year. Amazon and Google having a huge surge higher in recent weeks. They had been lagging. Now they're leading, up 73% and 57%. And while Apple's come in, still up 36% on the year. And if we look at the average stock, not even close to this. So the S&P equal weight up 6%, small cap stocks up 5%. So most stocks not having this tremendous year. This was really unexpected coming into the year in terms of 2022. These were the worst performing stocks. Big tech got crushed, and we've seen the reversal so far in 2023. So this has people feeling good again. The earnings were pretty good, particularly for Nvidia, many other big tech companies as well. All of that cost cutting that they did last year led to higher profitability and higher margins, and markets pretty excited about that. And what's another way to measure markets' lack of fear and lack of volatility? We'll be looking at credit spreads. So in the high yield space, or junk bonds as they're called, you look at the spread between that high yield bond and a risk-free security, so a treasury security of similar duration. So if we look at that spread over time, you can see it tends to spike during periods where there's either fear in the markets or fear in the economy. We saw in 2020, obviously 2008 financial crisis. We saw the highest credit spreads we've ever seen. You had a 20% premium above that risk-free security for a brief period of time. But today, very little fear in the market. 3.78% is that spread above the risk-free security. That's the tightest spread we've seen since April 2022. So some would say bond market's the smart money, and that this is saying that the bond market is not expecting a recession anytime soon, because if they were, they would be thinking that defaults are going to go up, and therefore you would want a higher spread to be compensated for that. So we saw a little rise in credit spreads last year, but we talked about at the time that that was nothing in terms of recessions in the past. You typically got way wider than we saw. But this year, particularly the last few months, we're seeing a tightening in terms of spread. So this will be something that I'll be watching in the next few weeks to months to see if this continues or if we reverse course. But for now, markets saying economy's good. No corporate defaults are going to remain low, and these spreads are an indication of really a lack of fear in the markets. Now, IPO space is not something we've talked about for a while. In 2021, we talked about it all the time, particularly in the first few months of that year when there was an absolute mania in terms of SPACs and IPOs. But finally, the big IPO is back, and this is something people were waiting for. And they priced this IPO at a pretty high level, and the shares actually did well on the opening day above that pricing. So ARM Holdings here, this is a semiconductor chip designer. So they're not actually making the chips, but designing them and licensing that to manufacturers. And the stock had a huge first day, and it's trading at a pretty rich multiple, which is kind of surprising, but maybe not. But it shows you that this was, in fact, the right time for this company to go public, because they certainly weren't punished for it. They certainly were trading at a valuation, I would say, that is a premium well above like market comp. So let's take a look at that and dig into that in terms of price to sales ratio. So here's ARM Holdings compared to Nvidia. So you would expect it to be lower than Nvidia, but much higher than other big tech companies. And the interesting thing here is I dug into the financials is you would expect with a price to sales ratio of 24, which is very, very high. It would be that if it was in the S&P 500, it would be one of the highest multiples in that index. You would expect to see an enormous growth rate, and that's what I expected to see when I looked at the financials. But you actually see negative year-over-year sales growth for ARM Holdings. So not like Nvidia, where you're seeing just this rapid, tremendous growth. You're actually seeing a decline in sales over the last year. And then I looked at net income; it was also lower than a year ago. And I looked at the price to earnings ratio, and you're looking at well over 100 times earnings in terms of this ARMS holding. So, sign of sentiment. That sentiment is clearly back. Clearly, investors are paying a premium for this company. It remains to be seen if it can, quote unquote, grow into this, as people often say. But many people said the same thing in early 2021, only to be disappointed. So we had these lofty price to sales ratio on pretty much every issue that came out in early 2021. You saw 20, 30, 40 times sales, even well above that. If we look at a company like Snowflake, just crazy. And I wrote about it at the time, a crazy, crazy valuation for a company of its size. But the IPO is back, and investors should be very careful when it comes to IPOs in terms of checking their sentiment, checking their optimism. And this is a chart that really illustrates that, because since the beginning of 2021, and IPOs had a huge run in 2020, far outpaced the market. Everybody was rushing into this IPO ETF. If you look at the flows, just massive flows at the end of 2020 and into early 2021. And if we look at the return since, you could see this IPO ETF is down 48%, while the S&P 500's gained 25%. So the idea that it's easy or simple to buy an IPO and outperform the market, or even buy a collection of them, simply not true. And that's especially true when you have this excitement, you have this extreme optimism about the future, because then it just becomes harder to meet that lofty expectation. So we'll see if ARM can meet that expectation, but surprising to me that it's trading at such a high premium to other tech companies, while its growth rate is actually down over the last year. So this could be a sign, though, of investor sentiment. If we look at that VIX and we combine it with the tech returns this year, investor sentiment's back. So this won't be the last IPO. We have the Instacart coming next week, so that's a big one as well, and we'll talk about that on the next week in chart. So other big story this week: the big demands from the United Auto Workers. The union decided to go on strike as their demands weren't met. The negotiation process is still going on. So a couple of plants have been shut down already. The fear is this is going to continue. We're going to see extended shutdowns in terms of the big three, and what the UAW is demanding, and we'll see how successful they are, is just astronomical increases and things that are really unheard of in the private sector. So looking for 40% increase in hourly pay over the next 4 years, so 10% a year. They want to work less for that higher pay, so get a 4-day work week or 32-hour work week. They want a faster path to top pay. They want to go back to defined benefit pensions, so something that had existed, obviously for decades, but they eliminated that. And like most private companies, more 401k system, but they want to go back to that. Want cost of living adjustments. That's certainly understandable, so to keep pace with inflation. But they want more vacation time, holidays, extended parental leave. And Ford said in response to this that if they had implemented these provisions over the last 4 years, they would have lost $14 billion instead of making $30 billion in profit. So there has to be something in between this and what Ford and GM are looking for, because obviously you can't do something that's going to lose such a significant amount of money. Then it kind of defeats the purpose for the workers, because they might have higher pay for a short period of time, but then they won't have a job if the company goes bankrupt because of the cost structure. So this might be just an initial thing where they're shooting for something very high. It's a negotiating tactic, but I wouldn't expect them to get anywhere close to this. And if they do, it's going to lead to a pretty difficult time for the companies, for Ford and GM, just in terms of profitability. So there's different ways to look at it. Some might argue oh, they have $30 billion of profits. That's too much, and the workers should get more. And I would probably agree with that based on this chart here, which is showing just overall terms of labor share of corporate income, really trending low over the last 40 years. And if we showed a chart since 1950, it would be an even more significant decline. And really, in recent years, with that inflation spike, this has been front and center for workers. So pushing for higher pay is important in any period of time, but particularly when you have high inflation. And so clearly that's part of this. And clearly the worker now has somewhat of the upper hand because of that supply demand dynamic that we've talked about. So we still have a lot of job openings. We don't have as much supply of labor as there is demand, and so this is probably the UAW striking while the iron is hot and trying to get some of those benefits while we're still in an economic expansion and we still have that relatively tight labor supply, although it is loosening. So we'll see what happens here. This would be a big shift. Let's say if this marks a trend where labor is starting to get a higher share of the pie, well, then you're talking about lower profit margins for businesses and perhaps lower valuations. But that's a longer term trend. We don't know if that's going to happen. But clearly, if we look at companies like UPS and what happened with them in terms of paying their workers, and we can give countless examples of that in terms of wage increases, this is becoming more and more of an issue. Now, who is the big winner in terms of the strike? And let's say they meet in the middle or meet somewhere or meet some of the demands. The big winner is going to be Tesla because Tesla does not have unionized workers and they're going to pay whatever the market wage is. And presumably things like pensions are not part of the market wage because I don't know anybody who has a pension outside of government workers nowadays. So I doubt that's going to be approved. But if they approve these huge increases in wages that aren't market based, well, that value, that additional value is going to go to Tesla. And they've already been taking share every single year, and that'll likely continue. So Tesla last 10 years up 2,390%, while you have General Motors up 24% and Ford up 17%. So certainly shareholders should be concerned if they strike a deal here that's going to cause GM and Ford to lose money. Because companies haven't been doing well over the last 10 years already. And the last thing they need is additional cost to make their business less competitive versus a company like Tesla or Toyota. And if we look at Tesla prices continue to go down. So they're really going for it here. They're continue to drop prices. We're seeing this every few months this year. And the average price of a used Tesla now is getting closer and closer to the average used price of an overall car. So we went from a situation where Tesla was this premium luxury good, and it still is higher priced than the average car, but that is changing very rapidly here from 67,900 at the peak in 2022, just a little over a year ago, and now we're down to 41,000 average price of a used Tesla. So dramatic shift. Talked about this. Tesla's going for market share, and they're compromising on profit margins for now to try to achieve that. And the average price of a car in general, though, is moving in the opposite direction. And the question would be for Ford and GM, are they going to have to raise prices here to account for higher wages? And this is kind of the concern. There's no question that costs, if they approve this, are going to go up. And will they try to pass that on to the end consumer? I think that's probably likely. And obviously, with the limit, and if this strike continues for some period of time, it's going to cause supply issues, and that's going to drive up prices as well. We've already seen an over 30% increase in car prices over the past 3 years, which is pretty significant. Not only that, but we have interest rates on new car loans skyrocketing as well. So it's becoming more and more difficult to afford a car already. And what impact are these increases in cost for the big three going to have on prices? But if they're forced to raise prices while Tesla is still cutting prices, that's just going to be an additional thing that accelerates Tesla's gaining market share, you would say. And that's kind of Elon Musk's plan here, is to have as many Teslas on the road as possible. And the thinking there is that's going to lead to an ecosystem for Tesla where they can monetize it in other ways, and that's going to be beneficial when we eventually have self-driving cars. But that's all years from now. In the short term, Tesla appears to be the winner in terms of this strike and just the overall environment now, where other companies are raising prices and Tesla is cutting prices aggressively to try to increase market share. So let's talk about retail sales. So speaking of car purchases, well, that's clearly decreased significantly over the past few years, particularly over the last year because of that spike in rates, and most people finance the cost of a new car. Over 80% of people. So we're seeing declines in car purchases, but we're seeing declines in overall retail sales as well. And the way I like to break this down is first on a nominal basis. So the blue chart at the top there is showing just nominal retail sales, so total dollar of sales. That's up 1.6% versus an average over the last 30 years of 4.7% increase. So that's been slowing. But more importantly, you want to adjust for inflation. And the bottom chart in red there is showing you inflation adjusted retail sales, and that's actually down 2% over the last year. And that's the 10th consecutive year over year decline in terms of real retail sales. And when was the last time we saw retail sales decline on a year over year basis for that many months in a row? You have to go back to 2009. So you have to go back to the last recessionary period. So is this by itself enough to push the economy into a recession? Maybe not, but certainly you don't want to see this trend continue where consumers are pulling back, and after inflation, they're actually spending less than they did a year ago. Now, the question is, what could make this worse in the next few months? Number one thing that people are thinking about or talking about would be the fact that student loans are going to have to start being paid back again. So we had a long period of time since March 2020 where 44 million borrowers did not have to make that monthly student loan payment. So if you had a mortgage payment, you still had to pay that. You have a credit card payment, you still have to pay that. Any other debt, car payment, you have to pay that. But student loans were the special class where they didn't have to make that payment for all of this period of time. Well, that's coming to an end. And on average, that's a decent sized payment. You have between $200 and $300, according to the Fed. And JP Morgan said this is going to be about $10 billion a month in terms of those payments. So that $10 billion, well, part of it was, of course, being spent. A certain amount obviously could have been saved and do other stuff, invest it. But I think a large portion of that was simply being spent. And now that money, now it's going to have to be a choice in terms of you don't have that $300 a month anymore. That's $3,600 a year. Well, maybe you're not going to make that purchase of a new clothing item that you don't really need, or maybe you're not going to take that vacation. So the question is, how big of an impact is this going to have, and what's going to be cut? And we'll just have to watch it and see. I don't think this is enough by itself, let's say, to push the economy into a recession, but it's certainly a thing that the retail sector did not need because it's already under pressure, and this will likely lead to something. The question is how much of a pullback this is going to lead to. So let's talk about another fear in terms of the economy, and that would be lending standards. And we've shown this chart a number of times over the past year, but it continues to trend in this direction, particularly following the banking scare earlier this year. We've seen this trend higher. Banks are tightening their lending standards, and they tend to do this during periods of economic weakness. So we saw this in the 1990-91 recession, 2001 recession, 08-09 recession, and the 2020 recession, tightening their lending standards each time. And now we have a net percentage of banks, 51%, tightening their lending standards. So it's going to be harder to get a loan. And so the fear is that the rate of interest on these loans is going up. It's harder to get the loan. So companies are going to take out less loans. That means less spending, less economic activity. And you could say that's just another factor, perhaps, that will lead to a slowdown in the economy. Now, what's the counter to that? Why, if retail sales are slowing and lending standards are tightening and we have this pressure on the consumer because interest rates are going up, why aren't we seeing that decline in economic activity? Well, the number one reason I think would be the fact that the government is still borrowing and spending a massive amount of money. So, huge amount of deficit spending. The government over the last year spending 9% more than they were a year ago, while the tax receipts are actually down 8%. So if you or I did this, people would say, that's crazy. You can't do that. You have to balance your budget. You can't be spending more if you're making less. For the government, this is standard operating procedure. And so $2 trillion deficit, borrowing and spending $2 trillion, well, that's stimulative. And in the short run, people are excited about that because that's leading to higher economic growth. The question in the long run is, what are going to be the consequences of that? What are the consequences of building this amount of debt that we've built over the past 5 years? So past 5 years, we've gone from 21 trillion to almost 33 trillion. We're pushing up on 33 trillion now. That's a 54% increase in just a 5-year period. So enormous increase. And since that debt ceiling was lifted, let's say there's actually no limit anymore. Since it was suspended a few months ago, just in June, it's only been 3 months, we've added $1.5 trillion to the national debt. So again, the problem with this is not a short-term thing. It's a longer-term thing where when the debt goes higher and the interest cost on that debt goes higher, well, at a certain point, that's going to crowd out the spending that the government can do in other areas, essential areas. It's going to be more and more difficult when you compound this number and it gets higher and higher to service that debt. So not a short-term fear, but longer-term fear. But nobody seems to be talking about that. But for now, is a contributor to the economy. So while we're seeing retail sales slow, while we're seeing credit standards tighten, what we are seeing is that this government spending has been a big factor lifting economic growth. And it's going to continue if the expectations are correct in this third quarter here. So we have the Atlanta Fed does this real GDP now forecast where they're essentially just plugging in economic data points throughout the quarter and turning that into an expectation for GDP. And you should really ignore the early numbers because as data points come in, this almost always starts high and trends lower. But the fact that it's close to 5%, it's pretty interesting here. Again, I suspect that will definitely come lower. But to me, the more interesting thing on this chart is the blue chip consensus in terms of Wall Street's expectations. So they do an average of the big banks and their expectations for Q3 GDP. And you can see started out at 0 just a few months ago, and now we're pushing up to close to 3%. So clearly the consensus is no recession in Q3. That economic growth is actually going to accelerate and maybe we'll be at 3% or maybe even higher for third quarter growth. So that would be a great thing. The question is how much longer we can maintain that in terms of the deficit spending, but doesn't seem to be a concern right now. I hear very few people talking about that. So perhaps, again, we have to wait till it becomes more of a crisis before this is front and center. And we're not yet at that crisis level, even though we had that downgrade in terms of the credit rating, and even though interest costs continue to rise pretty much every month. So let's end, as we always do, with a positive note. And this is the fact that real wages are going up again. And for a long time, I had to report this negative. So I'm happy to report this positive. And why is this so important? Well, this is what we feel every day economically. And why the last 3 years have been so difficult for many people is that our wages simply weren't keeping pace with higher prices. So awesome that wages have gone up 15% on average over the last 3 years. Normally we'd say that's incredible. I'll take that every time. We haven't seen wage growth like that in a long time. So that's great. The problem is that the prices that you pay for things over the past few years have gone up in most cases far in excess of that 15% increase. And if we look at food, up over 20%, and we look at car prices, new and used car prices, much higher. Used cars 32% higher. Home prices 40% higher. Things like fuel oil and gasoline significantly higher over the past few years. So this is so important. You want wages to be outpacing inflation. and now they finally are again. So here's the chart, to me, most important chart that I look at every month. It's comparing real average hourly earnings over time. So this is saying, in the past year, what have wages done? So in the past year, wages have gone up around 4.2%, 4.3%, and inflation is 3.7%. And you look at the difference, and that's your real wage growth. So over time, the last 20 years, last 50 years, last 100 years, if we look at a chart of real wages over time, it's up and to the right. And that's why people are better off today than they were 50 years ago, and much better off than 100 years ago. And in the short run, you can have periods like we had here where you could go in the wrong direction, the opposite direction. And this is why people are feeling so lousy throughout all of last year, and why consumer sentiment was so low, because we had 25 consecutive months where inflation was outpacing wages. And that's not a good thing. That's not a good feeling, especially when things like food prices are skyrocketing out of control. So now we have 4 straight months where it's been the opposite. People are making more money than prices are rising, and that increase in purchasing power, increase in prosperity. So for the Fed, this is what they want to see. I think this is why, primary reason why they're comfortable pausing here. As long as this stays positive, they're going to be feeling pretty good. If CPI goes above 4%, though, again, and starts heading towards 5%, this turns negative, I think you're going to see very likely that the Fed is not done then, and they're going to have to hike again. So focus on this chart, and hopefully, again, it continues. And in the long run, I suspect that it will. But this is a chart you want to see stay in that positive territory, because we're all going to be feeling much better if our wages are outpacing prices. So with that, I'll end it there. Have a great weekend, everyone. Thanks for joining me on the Weekend Charts. If you like the content, as always, subscribe to the channel, and I'll see you next time on the Week